Most people approach 2026 with opinions, predictions, and emotions. But markets don't reward opinions. They reward understanding. The world is entering a period where debt, inflation, and monetary policy are reshaping how wealth is created and destroyed. Those who understand these forces will quietly position themselves ahead of time, while others react too late. These 5 rules are not guesses about the future. They are frameworks for navigating it logically and consistently. Understanding debt cycles is the foundation of building wealth because economies do not grow in straight lines. They move through repeating patterns driven by borrowing and lending. Every expansion begins when credit is easy and confidence is high. People borrow to spend, businesses borrow to invest, and asset prices rise as money flows freely. This phase feels safe and optimistic, which is why most participants believe growth is permanent. In reality, this optimism is the very force that plants the seeds of the next downturn. Debt itself is not harmful. When borrowing is used to fund productive activity that increases future income, it can accelerate progress. Problems begin when debt grows faster than the income required to service it. At that point, repayment depends not on productivity but on continued borrowing. This is how short-term debt cycles form. Central banks often respond by lowering interest rates, making borrowing cheaper and extending the cycle. Asset prices rise further, reinforcing the belief that risk has disappeared. Over time, interest rates reach levels where they can no longer be reduced meaningfully. Debt levels become too large relative to income, and the system loses flexibility. Borrowers struggle to meet obligations, spending slows, and lenders become cautious. This transition is not sudden. It builds quietly beneath the surface. Those who only look at market prices miss it. Those who study debt ratios, cash flows, and credit growth begin to see stress forming long before it appears in headlines. When deleveraging begins, the behavior of assets changes dramatically. What once benefited from easy money now suffers from tightening conditions. Forced selling, reduced spending, and declining confidence create a feedback loop. Policymakers attempt to manage this process through monetary and fiscal tools, but outcomes vary depending on the scale of debt and the credibility of institutions. Understanding this phase allows investors to distinguish between temporary volatility and structural shifts. Long-term debt cycles unfold over decades and are even more important. They are driven by sustained borrowing, rising inequality, and increasing reliance on monetary intervention. Eventually, traditional tools lose effectiveness, and authorities are forced to choose between restructuring debt, allowing defaults, or devaluing currency. Each path redistributes wealth differently. Those who recognize where their economy sits in this long-term cycle can protect purchasing power while others unknowingly bear the cost. For wealth builders, the key is not prediction but preparation. When debt cycles are expanding, leverage appears attractive and risk feels low. This is when discipline matters most. Building reserves, avoiding excessive leverage, and focusing on resilient assets creates optionality. When cycles contract, liquidity becomes opportunity. Assets are repriced, risk premiums expand, and patient capital is rewarded. Understanding debt cycles also improves emotional control. Market participants often confuse price movement with value. Rising markets are interpreted as validation, while falling markets are seen as failure. In reality, both are often consequences of credit conditions rather than fundamentals. By separating economic mechanics from emotion, decisions become calmer and more consistent. Debt cycles explain why similar mistakes repeat across generations. Each cycle feels new to those experiencing it, but the structure remains familiar to those who study history. Borrowing increases, optimism peaks, constraints appear, and adjustments follow. Wealth is not created by avoiding these cycles, but by aligning decisions with them. Those who understand where they are in the cycle stop reacting and start positioning, allowing capital to compound while uncertainty reshapes the landscape. Money influences everything in an economy, yet most people treat it as something fixed and stable. In reality, money is constantly being created, destroyed, and revalued through policy decisions and credit conditions. When the supply of money grows faster than the production of real goods and services, purchasing power declines. This process is gradual, which is why many fail to notice it until the effects become unavoidable. Understanding this dynamic is essential for protecting and growing wealth. Inflation is not simply rising prices. It is the reduction in the value of money. Prices are the symptom, not the cause. When central banks lower interest rates or inject liquidity, borrowing increases and spending accelerates. This can stimulate growth in the short term, but it also changes how assets are priced. Cash becomes less valuable over time, while real assets and productive businesses often adjust upward. Recognizing this shift early allows investors to move capital before inflation becomes obvious. Interest rates act as the steering mechanism of the financial system. When rates are low, borrowing is encouraged and risk-taking increases. Assets that depend on cheap financing tend to perform well in this environment. When rates rise, the cost of capital increases, debt becomes heavier, and valuations compress. This transition catches many investors off guard because it reverses trends that once felt permanent. Understanding how rate changes affect different asset classes prevents being positioned for the wrong environment. Money printing, while often misunderstood, is a tool used to stabilize systems under stress. It does not create real wealth. It redistributes it. Those closest to newly created money benefit first, while those holding cash or fixed income often lose purchasing power. This redistribution is subtle and uneven, which is why it goes largely unnoticed. Investors who understand this dynamic focus on owning assets that adjust with monetary expansion rather than being diluted by it. Different assets respond differently to inflation and deflation. Some perform well when money loses value, while others excel when money becomes scarce. Without this understanding, portfolios become fragile, relying on a single outcome to succeed. By aligning assets with monetary conditions, risk becomes more manageable and returns more consistent. This approach reduces dependence on forecasts and increases resilience across cycles. Psychology plays a significant role in how people react to monetary changes. During inflationary periods, rising prices can create a false sense of wealth, encouraging overconfidence and speculation. During deflationary periods, fear leads to hoarding cash, even when opportunities are emerging. Understanding money helps counter these emotional extremes. It allows decisions to be based on real value rather than nominal numbers. For long-term wealth builders, the goal is not to outsmart policy decisions, but to adapt to them. Monetary systems have evolved over centuries, yet their core principles remain unchanged. When money is abundant, value must be preserved. When money is scarce, flexibility becomes power. Those who recognize these conditions position themselves quietly while others react loudly. By understanding how inflation, interest rates, and money creation interact, wealth becomes less vulnerable to forces outside personal control. Capital is allocated with intention rather than hope. Instead of asking where prices are going next, the focus shifts to how money itself is changing and which assets are aligned with that reality. Diversification is often discussed as a basic principle of investing, but its true power lies in understanding how different assets respond under varying economic conditions. Owning multiple assets is not enough if they all move together when the economy shifts. True diversification is about creating a portfolio of investments that behave differently during expansions, recessions, inflationary periods, and deflationary periods. This approach allows wealth to grow steadily while risk is managed intelligently. Economic conditions are never static. Some assets thrive when the economy is expanding and credit is abundant, while others perform best when growth slows or contracts. For example, equities in productive companies may rise during periods of low interest rates and high consumer confidence. On the other hand, certain bonds or commodities might protect value when inflation increases or when market volatility spikes. By identifying which assets respond to which economic drivers, investors reduce reliance on any single outcome, creating a buffer against unexpected events. The timing of economic cycles is difficult to predict with precision, which is why diversification across scenarios is critical. A portfolio focused entirely on growth during expansion may suffer significant losses when credit tightens or interest rates rise. Conversely, a portfolio focused only on defensive assets may underperform during periods of recovery and innovation. By combining assets with uncorrelated behaviors, investors maintain a balance that provides opportunity during favorable periods and protection during challenging ones. Diversification also mitigates emotional risk. Humans are naturally prone to overreacting when markets fluctuate. Without diversified exposure, sudden downturns can trigger panic selling or impulsive decisions that harm long-term wealth. A diversified portfolio smooths the impact of volatility, allowing investors to act with logic instead of emotion. This consistency in behavior often produces better results than attempting to predict every market movement or chasing short-term gains. Moreover, diversification is not limited to asset classes. It extends to geographic exposure and industries. Economies do not move in perfect synchronization. Political events, regulatory changes, and regional growth patterns influence the performance of markets differently across countries. Owning assets in multiple geographies and sectors ensures that localized risks do not derail overall wealth accumulation. Even within sectors, some companies or commodities respond differently to economic shocks, further enhancing protection and potential growth. Understanding diversification also requires regular review and rebalancing. As markets change, correlations between assets may shift. What once provided protection may become more aligned with risk, and vice versa. Maintaining a diversified portfolio is not a one-time task. It is an ongoing process of monitoring performance, assessing conditions, and adjusting allocations to ensure that the portfolio remains aligned with objectives. Long-term compounding is amplified when risk is controlled through diversification. While concentrated bets can produce occasional spectacular gains, they are far more likely to result in permanent losses. Wealth that grows steadily over decades comes from a combination of opportunity and protection. By allocating capital across uncorrelated assets, investors reduce the likelihood of catastrophic drawdowns and improve the probability of consistent, sustainable growth. Finally, diversification is a tool for adaptability. No one can predict every economic shock, technological disruption, or geopolitical crisis. A well-diversified portfolio allows investors to navigate uncertainty while maintaining exposure to potential upside. It is a system that works not because it eliminates risk, but because it distributes risk intelligently across multiple environments, ensuring that wealth continues to grow even when the future is unpredictable. Emotions are the enemy of consistent wealth building. Most investors make decisions based on fear, greed, or impatience, reacting to short-term market movements rather than long-term realities. Emotional decisions often lead to buying high and selling low, which is the opposite of what creates wealth. Building systems to guide decision-making allows individuals to act logically, reduce mistakes, and capitalize on opportunities when others are acting impulsively. A system begins with rules. By establishing clear principles for investing, individuals remove guesswork from the process. For example, deciding in advance how much to allocate to different asset classes, what conditions trigger rebalancing, or when to exit a position prevents decisions driven by panic or excitement. These rules act as guardrails, ensuring that choices remain consistent with long-term objectives, regardless of market noise. Data is another critical component of a decision-making system. Emotions are fueled by anecdotal evidence, news headlines, and personal bias. Systems, on the other hand, rely on measurable metrics and historical patterns. Evaluating assets based on cash flow, debt levels, economic indicators, and risk-adjusted returns provides an objective foundation. When decisions are anchored in data, the influence of emotions diminishes and clarity increases, allowing for more precise and rational investment actions. Scenario planning enhances system effectiveness. Markets are inherently unpredictable, and no single outcome is guaranteed. By preparing for multiple scenarios, expansion, recession, inflation, or deflation, investors can create responses in advance. This proactive approach reduces stress and eliminates the temptation to react hastily when conditions change. Having predefined actions for each scenario keeps decisions aligned with the broader strategy, rather than being dictated by the immediate market environment. Emotional control also extends to risk tolerance. People often misjudge their ability to withstand losses until they are confronted with them. A system allows risk levels to be defined and adhered to, preventing overexposure during times of euphoria and underexposure during times of fear. Knowing the rules in advance provides confidence to remain patient and disciplined, which is often more important than choosing the perfect investment. Automation can further reduce emotional interference. By using predetermined thresholds, automatic rebalancing, and systematic entry or exit points, the influence of mood and impulse is minimized. Systems do not experience excitement, frustration, or regret. They execute strategies consistently. Over time, this consistency compounds into better performance because decisions are made rationally, not emotionally. A well-designed system also encourages continuous learning. Markets evolve and economic conditions shift. Systems should be reviewed and refined regularly to incorporate new information, improve risk management, and adjust allocations based on changing patterns. This adaptability ensures that emotional reactions are replaced with informed actions grounded in experience and analysis. Finally, systems create confidence. Emotional investors often hesitate, miss opportunities, or act prematurely. Having a framework allows decisions to be made with clarity and certainty, even in volatile markets. Confidence does not mean ignoring risk. It means understanding it and responding in a consistent, disciplined manner. By building and adhering to systems, wealth accumulation becomes less about timing, luck, or instinct, and more about executing a repeatable process that works across a range of economic conditions. Humility and adaptability are essential traits for building and maintaining wealth because no one can predict the future with certainty. Markets change, economies shift, and unexpected events occur that can quickly upend even the most carefully constructed plans. Investors who cling rigidly to their assumptions or past successes often fail to recognize new realities until it is too late. By cultivating humility, individuals accept that mistakes will happen, that they do not have perfect foresight, and that learning and adjusting are ongoing necessities. Adaptability begins with the recognition that circumstances evolve. Economic cycles, Interest rates, inflation, and global events are constantly in flux. Strategies that worked in one environment may fail in another. Investors who remain flexible, willing to revise their assumptions, and ready to reallocate capital when conditions change are better positioned to preserve and grow wealth. Adaptability is not about reacting impulsively. It is about observing objectively and making informed adjustments based on evidence. Humility also helps counter overconfidence. Many investors assume that because they have been successful in the past, they will continue to succeed in the future. This mindset can lead to excessive risk-taking, ignoring warning signs, or doubling down on failing positions. Accepting that no one is always right encourages careful analysis, thorough risk assessment, and a willingness to seek advice or alternative perspectives. This self-awareness acts as a safeguard against catastrophic mistakes. Learning from mistakes is a direct outcome of humility. Every loss or misjudgment carries lessons about markets, human behavior, and personal decision-making tendencies. Investors who study these lessons objectively refine their strategies and reduce the likelihood of repeating errors. Adaptability ensures that these lessons translate into actionable changes rather than remaining theoretical knowledge. This cycle of observation, learning, and adjustment strengthens long-term decision-making. Adaptability is also crucial when considering the pace of innovation and global change. Industries evolve, technologies disrupt established business models, and geopolitical events shift trade and capital flows. Investors who fail to recognize these dynamics may miss opportunities or suffer losses. Those who continuously monitor trends, remain curious, and are willing to adjust allocations are better positioned to capture growth in emerging areas while protecting against exposure to declining sectors. Emotional flexibility complements adaptability. Markets are often volatile, and unexpected events can trigger fear or overexcitement. Investors who cling rigidly to preconceived notions are more likely to make decisions driven by emotion. Humility encourages the acceptance of uncertainty, while adaptability provides the tools to respond thoughtfully rather than reactively. Together, they form a mindset that balances caution with opportunity. Diversification is closely tied to adaptability. By spreading investments across various assets, sectors, and geographies, investors create room to adjust when conditions shift. A rigid portfolio may perform well temporarily, but becomes vulnerable when assumptions fail. Flexibility in reallocating resources based on emerging conditions allows investors to stay aligned with both risk tolerance and long-term objectives. Finally, humility and adaptability foster resilience. Financial markets are unpredictable, and losses are inevitable. Investors who accept this reality, learn from mistakes, and adjust intelligently can recover faster and continue compounding wealth over time. Those who resist change, ignore warning signs, or assume permanent control over outcomes often experience setbacks that are more severe and longer lasting. By embracing these principles, decision-making becomes more measured, strategic, and effective across a wide range of economic environments.